remember the start of the class, we talked about the goals, and so you really need to learn these things so it will help you get where you want to go. So check it out. So this is the beautiful thing about depreciation. So we used 100% of the vehicle, right? It doesn't have to be a new vehicle. It just has to be new to you. And so whatever you purchase that vehicle for, it could be used, could be new, you can write that off 100%. Now, the tax code is changing, and so in 23 it went down from 100% from 22 to 23. Now it's 80%. 24 it's going to be 60%, and 25 is going to be 40%. So it's going to go down till it's gone. There is legislation that's being proposed to keep depreciation going. You know, I can't see with all the you know, the inflation and the tax, you know, in the stall of the market, I can't see this really going away, but however, technically it is going away. Hopefully there's going to be new laws that bring it back, but for right now, bonus depreciation for vehicles is going away in a number of years. So, but this year he could write off 100%. And so if you look at the line depreciation on this income calculation worksheet, this beautiful thing right here is a plus. You see these pluses and minuses. And so we could take that $61,000, his taxable income, and add the $96,000 back to it on a Schedule C. His income went back up to 158. So he only paid taxes on the 61. See this? That's where you're winning. He's only paying taxes on the 61, but as a lender, we can use depreciation 100%. We can add it back. So that's the magic. That's the magic of this situation. Depreciation is key. So if you can learn depreciation, you know, if you're going to own a real estate portfolio, there's these things called cost segregation studies, and these cost segregation studies will go through your rental properties and break out and give you a report that you can provide that to the IRS, or provide it to your CPAs, so that they can use those verified third-party numbers for depreciation. You can, everything has a depreciation schedule. Like a whole house has a depreciation schedule of 27.5 years. And so the house in the government's eyes is going to be completely renewed every 27.5 years. And so that is something that you can use. Carpet has a different depreciation schedule than the roof. Your appliances, all those kind of things have a different depreciation schedule. It's great to learn. It's great to use this stuff because it will help you, you know, with tax liability and qualifying for more loans. Make sense? All right, so if we look at the next slide here, his income's the same. He's still making, if you average it out over 12 months, he's still making $13,000 a month, but he's paying $25,000 less to the IRS, right? And so he went from $33,000 on owing the IRS to $8,600 on the next slide, and his income is still $13,000 a month. So he was able to get the loan and pay a heck of a lot less in taxes. Okay.